Welcome to Module 7. At the end of this module, participants should be able to explain the concept and purpose of AML-CFT-CPF red flags, identify common money laundering, terrorism financing, and proliferation financing red flags relevant to legal practice in Nigeria, distinguish red flags from proof of illegality, apply red flags within a risk-based assessment framework, determine appropriate professional responses when red flags arise, avoid over-reporting while remaining compliant with NBA-AMLC expectations. Red flags are warning indicators suggesting a transaction, client, or instruction may involve money laundering, terrorism financing, or proliferation financing. They do not constitute proof of wrongdoing. They trigger heightened scrutiny, not automatic reporting. They must be assessed collectively and contextually. They rely on professional judgment, not investigative certainty. For Nigerian legal practitioners, red flags serve as an early warning system within the gatekeeping function. Red flags derive their relevance from Rules of Professional Conduct for Legal Practitioners, 2023, and Nigerian Bar Association Anti-Money Laundering Appointment and Examination Rules and Protocols. Red flags relevant to lawyers are grouped into 5 categories: client-related red flags, transaction-related red flags, funds and assets red flags, corporate and structural red flags, jurisdictional and sanctions-related red flags. Client-related red flags includes reluctance to provide identification or ownership information, insistence on anonymity or use of nominees without justification, use of intermediaries without clear reasons, client profile inconsistent with transaction size or complexity, concealed or downplayed politically exposed person (PEP) status. Transaction-related red flags includes transactions lacking clear legal or economic purpose, unusually complex structures for simple objectives, frequent changes in transaction instructions, requests for unusually fast completion without justification, payments from or to unrelated third parties. Funds and assets red flags includes unclear or inconsistent source of funds, funds originating from high-risk jurisdictions, cash-heavy transactions where non-cash alternatives exist, structured payments designed to avoid scrutiny, use of client accounts for unrelated third-party transfers. Corporate and structural red flags includes multiple ownership layers without a business rationale, frequent changes in directors, trustees, or shareholders, companies with no discernible business activity, use of shell or dormant entities, trusts or foundations created solely to hold assets without clear beneficiaries. Jurisdictional and sanctions-related red flags includes involvement of sanctioned individuals or jurisdictions, trade or corporate activity linked to conflict-affected regions, requests to structure transactions to avoid sanction screening, cross-border arrangements involving secrecy jurisdictions. The following are indicators of red flags specific to terrorism financing. Client involvement with charities or associations lacking transparency. Donations or funding inconsistent with stated objectives. Small but repeated transfers to high-risk regions. Property acquisitions near conflict zones without a clear rationale. Attempts to disguise beneficiaries of charitable or community projects. Indicators of red flags specific to proliferation financing include companies trading in dual-use goods without sector expertise, complex trade structures involving sanctioned jurisdictions, requests for nominee arrangements to obscure export control exposure, legal advice sought to work around international restrictions, unusual shipping, routing, or contract terms. Red flags do not automatically override confidentiality. Instead, professional responses to red flags include internal assessment and documentation, enhanced due diligence where appropriate, declining instructions where risks cannot be mitigated, reporting only when reasonable suspicion is formed. The rules of professional conduct ensure confidentiality unless the lawyer is facilitating illegality. When red flags arise, a lawyer should pause the transaction, seek clarification and additional documentation, apply enhanced due diligence if required, reassess risk based on new information, decide whether to proceed, disengage, or report through NBA-AMLC channels. Red flags are cumulative. A single indicator may not justify reporting. As a lawyer, there are common mistakes to avoid when dealing with red flags. treating every red flag as reportable, ignoring red flags due to client pressure or commercial interest, proceeding with transactions subject to later clarification, failing to document internal risk assessments, informing clients that concerns have been escalated. That concludes Module 7. By mastering the identification and response to red flags, you're strengthening your role as a gatekeeper, ensuring compliance, and protecting the integrity of your practice.